One such product that employs a hedge fund strategy is the Intercept Capital Fund. It invests globally in liquid listed securities and in the year to March enjoyed returns of 17%. And joining me now to discuss it further is CEO of TechInvest, which manages Intercept Capital Fund, Rick Steele. Rick, welcome to the program. Thanks very much for coming on. Right. An interesting product that you've got. Let's explain first of all how it works.
Well, picking turning points in share markets, as you know, is a very treacherous game. So we decided we would build a product that didn't rely on the ups and downs of share markets. It simply relied on good old-fashioned analysis of companies, picking companies that we think will outperform and matching them in a share market sense by selling companies that we presume will not perform.
So it's a hedge fund in the classic sense?
It is. In fact, it's the classic hedge fund strategy espoused by Alfred Winslow Jones back in the 50s. He did exactly that. He built a fund that had a portfolio of stocks and matched them with stocks he felt would underperform.
I mentioned in the introduction this year's results of something like 17% in the year to March, but how has it performed over the medium term? Because it's been around for now 4 years, hasn't it? That's
right. We launched the fund back in March 2004. The past year, through this very difficult period, has been a very good result for us. Over the period since inception in March, we've returned around 11%, and that compares with a cash benchmark return of around 6%, so a handsome outperformance. Yeah,
way beyond expectations, I would have thought.
It's about where we target to be.
How difficult is it to predict where overall markets will go?
Well, I think it's very difficult, and that, of course, is the reason we think this product has its true value. Our approach, as I said, is to identify companies we think will outperform, and that comes down to old-fashioned analysis of the success of those likely companies.
You don't publish short sales, only the long. Why do you do that?
Well, we believe in transparency because we think that's important. We certainly show them to our clients, to investors in the fund, but the conservative approach is to, in fact, just publish our long investments.
Is there an argument, though, that holding back the results of short sales is a backward step for transparency, which is one of hedge funds' biggest criticisms? That's also one of its biggest myths too. But
well, I think at the aggregate level, at the listed company level, it is important to understand the degree of short interest in a company. In the US, for example, it's published fortnightly, the short interest in all the major companies, from Microsoft down to the smaller companies. So I think that's something we can strive to achieve in Australia that's currently not the case, and it would make for a more efficient market if we did that.
Should stock lending be prohibited, do you think?
Stock lending, in fact, is a crucial and important component of our financial system. It allows for the proper functioning of markets, it allows for, enables the raising of capital, the establishment of the correct price for a security. Without stock lending, we would be a very immature market.
Well, we should point out that this is a practice not only sanctioned but encouraged by the ASX, and without it we may not have the kind of returns that we've enjoyed in the past. But the current the state of the markets and the collapse of companies like I said, Opus Prime, you deny that it is a result of short selling, but that was one of the main reasons.
Well, short sellers have been in operation for a long time, not just in this recent period of collapse. Just to put this into some sort of perspective, we've enjoyed a bull market in Australia and globally for 4 or 5 years. We had a sharp retracement from about October of this year to around March of around 25%. That was a globally induced credit crunch retraction in markets, and I don't think it had anything to do with particularly the impact of short selling. In fact, without short selling, you could argue that markets may have in fact risen to a higher level, and the decline in markets would have even been greater. Our industry body, that's the Alternative Investment Management Association, has published a paper on short selling which it posted to its website this week. The main thrust of the paper was to argue for a better transparency of aggregate positions at the listed company level. We think that would be very good for market efficiency. And also just to reiterate the importance of short selling in the overall financial market.
Would that be aided by publishing the short sales? Would that be one of the ways that you could...
Probably not at the individual participant level, because you're trying, that's a matter of commercial importance to that particular investor, and we have to protect the interests of our unit holders in the way in which we manage the money. But it would be important at the company level. I would like to know what the level of short interest is in the companies that we invest in or short sell.
So I'll just quote from your blog if I can. So rather than being the black knights, short sellers are the white knights that provide liquidity and help drive share prices to their equilibrium levels. So we got it all wrong?
I think short selling is a very important component of the overall market system. Without it, it would be very difficult to run a proper set of derivative markets. It would be very difficult for companies to raise capital. It would be very difficult to manage proper investment risk. And I think it would be very difficult to establish the true equilibrium level of share prices. I think it would be a pretty bad thing. In fact, you could argue that we would end up being the laughing stock of the region at a time when we're aspiring to be a regional financial centre.
I think probably one of the problems that everybody certainly agrees on at this point is that the law is murky at best.
I think we almost need a fresh sheet of paper. But in the meantime, we need to have a system that we can all rely on, and I think that the only way to achieve that in the short term is to provide greater transparency, and to do that we need to aggregate short-selling interest at the company level and publish it on a periodic basis.
Let's look internationally. Do other markets have more regulated short-selling?
The regulations are all slightly different, but on the point of...
How do we compare, say to the United States or Europe?
I think we're more complex and probably more onerous. But on the transparency point, there are markets which are far more transparent than ours, and we should aspire to be as good as those.
Such as?
The US in particular.
All right, let's go back to the product briefly. The focus is going to be on tech solutions in the foreseeable future, you were saying.
Yeah, we see some pretty big things happening globally on the supply side and on the demand side. On the supply side, we're seeing shortages and difficulties in energy, water, food. The rice price has tripled in the last year.
Yes, and it's been an extraordinary story, hasn't it, commodity-wise, this quarter?
And so there are clearly some supply-side matters. On the demand side, we're in a position where we're trying to now build out the developing world, building infrastructure and so on, and the clash of supply and demand, the only solution we see is technology. That's the only way we're going to get out of this difficulty. So we're certainly fishing in the right pond, and we're on the hunt for technology solutions that we can include in the portfolio.
You mentioned the sectors, but specifically what kind of companies are in the investable future?
Yeah, the sorts of companies that would be in the universe are some of the giants. The biotech giant Genentech, Microsoft, other household names like eBay. It's not a question of whether this company or that company does particularly well or particularly badly. Our observation has been that when we do well, it's when the whole portfolio does well. So it's when the sorts of themes we identify as being important then play out, and that's reflected in the share prices and then in performance.
Just finally, how do you see the market playing out in the next couple of quarters or to the end of the year?
Well, of course, with Intercept Capital, you don't need to worry. I mean, what we're trying to do is to pick the themes that are important, identify the companies that will either benefit or fail to benefit from changes in technology change and so on, and build a portfolio accordingly. All
right, take your hedge fund off and put a market cap on. Have we reached rock bottom, do you think? Or you don't want to speculate?
Well, I think it's going to be tough. I think it's going to be tough from here. We haven't seen the real economy impact of what's happened on the credit crunch side yet. We've seen some little bits and pieces of evidence. We've seen a bit of a correction back in markets, maybe a 10% rise. Historically, that's not usually been the bottom.
All right, Rick, we'll leave it there, but many thanks for coming on and talking to us about the fund and more specifically about hedge funds. I think demystifying some of the myths around us is all important going into the future. So many thanks for your time. And that's all we have time for. Certainly.